Welcome to Blockstream Talk. It's been a wild couple of weeks in Bitcoin market, so who better to talk to for some perspective than Blockstream CEO and co-founder, Dr. Adam Back. In this conversation, Adam and I discuss what happened to markets this week, what's wrong with DeFi, how Tether is different from UST, and what are the lessons we can learn from Luna. If you find this conversation useful, don't forget to like, subscribe, and share. Adam, good to see you. Thanks for doing this.
Good to see you. We're back again so soon.
Yeah, that didn't take long. Exciting markets the last couple of weeks here.
Yeah, lots of confusion as usual.
So I think maybe it would be helpful to start to do a quick rundown of kind of what's happened over the last couple of weeks and maybe talk about some of the key constituents of the Terra ecosystem as well, just so people are clear and we're starting on a firm base. So I think basically what happened was Terra US dollar, which is seen, I guess, by some people as an up and coming stablecoin, went from a market cap of something like 20 or 30 billion to low single digit billion in the pace of about a week. Over the same period, its token Luna, which I guess is the native token for their ecosystem, went from about $80 to less than 1 cent. And since then, it looks like Luna has been pulled off a bunch of major exchanges. And this kind of came on my radar, I guess, maybe in March. I started looking at this, and I actually didn't realize how much Bitcoin they bought. I thought they had about 40,000 Bitcoin, but it looks like their fund acquired, according to Elliptic, acquired more than 80,000 Bitcoin, which, putting it in perspective, that's almost 2 times as much Bitcoin as Tesla has on their balance sheet. So it's proper numbers. And then I guess what happened was they were forced to dump that Bitcoin to maintain their stablecoin. I think that's theoretically what was supposed to happen. I think some of it went to market makers, and we're not entirely sure where all that Bitcoin went yet. So I think that still has to play out. And then in terms of their ecosystem, as I understand it, there's 2 main parts. There's Luna, their native token, and then there's UST, not to be confused with USDT, Terra USD, which is supposed to be a decentralized algo-based stablecoin. And I guess the primary mechanism here was pegging it to $1. So if Terra traded below $1, then you could swap it for $1 of Luna. And if Terra traded above $1, then you could do the opposite. So I think that's kind of a summary of what happened and kind of how their mechanism worked. Is that anything to add on that, Adam, or is that kind of, you agree with that?
That's correct. I mean, and I had a similar timeline myself. You know, there are lots and lots of DeFi-related quasi-Ponzi-like things with probably unsustainable rates and so forth. So I don't really track them too much, but I started paying attention when some Bitcoin enthusiasts were tweeting enthusiastically that Terra had, Terra Money, whatever the organization is called, let's call it Terra Limited, was buying Bitcoin in large quantities into the, at so many per week, so many per day, heading up towards the 80,000 that you mentioned. I think the other thing worth saying is apparently I was just looking at some basic stats over the weekend, and apparently the Luna market cap, which is like kind of shares in Terra Limited, if you like, went up to almost 40 billion. And so the sort of price pullback for Luna holders after this collapse was a millionfold, I think. So if you were, holding, I guess, $10,000 of a Luna, to put it in perspective, you would now have 1 cent or something. Now, of course, people are speculating on the bottom, trying to buy the dead cat bounce. It's getting delisted. Yeah. People are trading leverage. So that's all highly dangerous, and it's presumably pretty dead at this point reputationally. And in terms of, there was talk at one point of the Luna Foundation, I guess it's called, trying to find additional investors. Structurally, in terms of how it was bootstrapped, apparently, because I started asking questions just to understand in March when I sort of noticed them buying Bitcoin, and people were enthusiastic about that. Yay, another institutional buyout. I was like, well, wait a minute. Are these guys idiots buying Bitcoin, and they'll be forced to sell them all at once? And so I asked questions, just basic due diligence questions, like, well, what kind of collateral are you using to buy the Bitcoin? And their answer was, well, we had 1.2 billion of VC money, basically. So crypto fund money, I guess. Mostly VCs who are, investing in the crypto space, I guess, right? And they were hoping that would grow to, I think, 3 billion of VC money. It wasn't completely clear to me how much was there, but at least there was some money there. But nevertheless, the question remained, are you mostly collateralizing sort of with shares in the thing itself, like shares in the stablecoin management company? And evidently they were. I think at peak, the Bitcoin collateral was maybe 10%-ish of the overall collateral, and the rest of the collateral was Luna tokens or shares. So, and my general question was, as if there's a loss of confidence and the price of Luna falls, you'll be forced to sell more and more of it, and the same with Bitcoin, right? So, I guess people may not be familiar with the risks of leverage when you're using as collateral the thing you're buying itself, right? So you get this effect with Bitcoin collateralized perpetual futures. So on a number of exchanges like BitMEX, Deribit, the collateral is Bitcoin itself. And so the problem there is if you buy, Bitcoin at $40,000 and you use some Bitcoin as collateral, and the price falls, your problem is double, hence the quadratic, right? Which is the price has fallen, but also the value of your collateral has fallen correspondingly. So you're kind of 1 times longer than on a perpetual future platform like Bitfinex is actually US dollar or Tether backed, Tether collateralized. So your collateral is not eroding. So that has a kind of risk property that in a falling market, things escalate very quickly. It drops precipitously. And in the event, that's actually what happened with Luna.
Yeah. So the point of your tweet, I think, also was there's a problem with market cap too, right? Like I noticed this with Ripple and XRP back in kind of 2016, 2017, is that they had this huge market cap, but a huge amount of that was escrowed away. So it made it look, and this happens repeatedly with a lot of these smaller coins and tokens, is it looks like it's a lot bigger than it is. And then when you try and trade it, there's no volume there. So that's kind of a part of the problem as well, I guess.
Yeah, well, I mean, I think, of course, they had a white paper, as all coins and tokens and ICOs do. And the general mistake is to assume that prices are continuous and that there's unlimited liquidity, neither of which is true in a distressed situation. And so they even had like an academic paper written by somebody with some academic credentials, but evidently, whoever wrote that was not kind of a markets guy to realize the reality of it. And, of course, even if there is liquidity, while the thing is growing, that doesn't mean there'll be liquidity while it's shrinking, because once confidence is lost, everybody heads to the door, and there are very few buyers.
It's like a bank run.
Exactly. Yeah. So, I mean, the other interesting data point is because of the mechanism where I think you described it at the outset here, but if the Terra dollar, I'll call it that rather than the other phrasing because it's confusing for Tether. So the Terra dollar if it falls below par, the user is able to redeem it from a somewhat decentralized bot for $1 worth of Luna, and they create the Luna at that moment. So it's sort of inflating away the supply. So it's to the detriment of all Luna holders, basically, because they're creating more and more supply. So and what happened was a massive explosion of of Luna coins. So I think it went from like, I wrote this down here. So I think 35, was it 350?
I think it went into the trillions now, didn't it?
Yeah, but it started at like in the tens of millions, and it ended up at 6.5 trillion. It's probably more since then because it's probably still. Actually, I think they cut it off finally because it got out of control. But yeah, so it basically diluted people, and that was a big part of how the price fell so precipitously. So an analogy is that let's imagine that it's a bank and it doesn't have a central bank backing, and if it runs short of money, it will redeem by diluting its own stock and giving you $1 worth of stock for each dollar you deposit. And in a normal band of a bit of up and down, a bit of adoption and a bit of redemptions, that could work. But once the confidence is lost, of course they're going to dilute their bank stock. And once the market cap of the bank falls below the market cap of the dollars in circulation, then that becomes obvious to everybody that this is not going to work, and the last one out is going to lose their shirt, and it starts a stampede, and that just escalates it.
Yeah, and so as this thing blew up, we started to see a lot of other news around stablecoin. So how do you think the UST blow up spilled over into other stablecoins like Tether?
Well, I think the level of there's sort of information asymmetry is pretty extreme in these markets. So in conventional markets, public market stocks, there are large funds like pension funds that have positions. There are professional analysts who write analyst reports. There's a cash flow, there's a balance sheet, there are quarterly audited reports, and there are accounting standards and independent Big Four audits and so forth. So if a stock is low and becomes analyst recommended, or if the fund managers think that below that price it's a buy, they'll step in and buy it. But in the crypto space, I think there are many more kind of retail traders, and there's much more confusion because it's complicated. The information is not necessarily accurate, and so you'll get silly things like people realizing that stablecoins could be risky and selling all of the stablecoins for dollars or Bitcoin or something, regardless, in a short period of time, or pulling out of other DeFi platforms, realizing that DeFi platforms carry risk. Because I think, unfortunately, some of the people that put money into the Terra were looking for this 20% yield, and the fact that it's advertised as stable as a kind of low risk thing, right? And obviously that backfired. So, and I think the other factor obviously is that for Tether particularly is that the ticker for the Terra US dollar is UST, and the ticker for Tether US dollars is USDT, and it's almost suspicious. Like the Terra founders thought that they would, because Tether is the biggest stablecoin, it's the sort of highest reputation in a way, by far the most widely used in terms of trading volume, by like a factor of 10 as compared to everybody else combined. There was a kind of financial incentive for them to imitate it, and so by calling it UST, they could maybe create some confusion with USDT, and in some contexts on some platforms, USDT is abbreviated to UST as well, so it's actually like a ticker collision, literally, in some contexts. So that's a kind of misleading branding in a sense. So in any case, it seemed to cause confusion where some people were selling Tether and push the in-exchange price. There are sort of markets between Tether and dollars and Circle and dollars and so forth, and Gemini and dollars. And then there is a redemption mechanism where you can create an account with Tether, the company, deposit Tether and take out a wire transfer for 10 basis points fee if you have enough volume. Like there's a minimum fee of $1,000. So to get your 10 basis points, you need to move $1 million. And for most people, obviously, that's a lot of money and way out of reach. So they don't create a Tether account because the minimums are too large for them. And they will actually just sell it on a market. And the markets, I think that was the source of confusion, even of some mainstream financial media, where they incorrectly asserted that Tether also broke its peg, which it absolutely just simply didn't on a factual basis. And so I guess they just have never traded on crypto exchanges. I think a lot of journalists are actually precluded from owning Bitcoin, strangely. So they probably don't know how it works, but effectively they're on most of the exchanges, they have, one or two or more stablecoins and US dollars or other fiat currencies and a market. And there will be reasons. So it's just a supply and demand, right? And so it's an obvious arbitrage as well, because, if you've got liquidity and you're not in a hurry and it goes, and you're holding Tether and it goes below par, and it will do that all the time, it will be 10, 20 basis points below par on some part of the day, and it will be 10 or 20 basis points above par other parts. And there are people and bots that just arbitrage that. And so they're providing liquidity to people who have a time preference. Like they want Tether quickly because they see Bitcoin at a slightly lower price on another exchange, or they want dollars quickly because they're coming into the exchange and they want to, access a dollar market, which is cheaper for Bitcoin than another exchange or something like that. So you'll just have, if you think about two exchanges, one where there are more retail buyers, one where there are more, funds and whale traders, they can have different sentiment balances, so the price will be higher on one. And so, if you look at the Tether markets on those two platforms, one will be above par and one will be below par because of the move, because of the demand, until that price normalizes, and then it will go back. So, of course, on this particular moment, after the Terra has imploded, presumably there are Tether and Terra US dollars and other assets coming out of DeFi, landing on exchanges, getting converted. People are confused and anxious about anything that says DeFi or stablecoin in its name. So, they cause the market price to fall more than 10 or 20 basis points, like towards 100 or 200 basis points. And I think briefly like 450 basis points below, which is a lot. And, of course, underinformed people looking at that see it dropping by 200 basis points and they hit panic sell, right? And the mainstream media is not helping because now they're saying, they're falsely reporting, and then people sell on a confusion, right? Now, all that really did was hand free profit to people who had liquidity, were able to arbitrage it. It's also possible to play that market with leverage. There are Terra perpetual futures, so you could 10x long that and make more money still.
Yeah, I think also if you've got a little bit of experience under your belt, I think for a lot of people this was probably their first rodeo. So to see a wobble in Tether and to see something kind of big in the broader crypto digital asset ecosystem blow up, it's probably pretty panic inspiring. But I think if you've had you've been through many cycles, so I think you've seen variations of this story a couple of times. So that's another different kind of asymmetry as well.
Yeah, I mean, I think the other factor here is with the rise and then rapid fall of Terra is
that's unprecedented. I think I've never seen anything come up so quick and blow up so quick. I don't think.
I guess it's a confidence thing. A lot of naive investors and some of it is not transparent yet, and some of it may not become transparent for years even. We'll see how it plays out. It's still a moving story. But I think one part of it was the yield guarantee. So apparently Tether is also a network, I presume a clone of Ethereum or something like that. And they had their own yield product where people could borrow and lend. And the lending, sorry, the lending to it was artificially increased. So I saw estimates that the fair market lending rate to borrow from this anchor protocol would be like 6.5%. Nevertheless, it was paying 20% or 19.5%, basically because the Terra company or investors or ecosystem was intentionally subsidizing the interest rate. So they had put extra capital into a pool for the anchor protocol to inflate the interest rate. So, what does that do? Well, it gives people an incentive if they believe that this is secure, that the interest rates, either they don't understand, they think those interest rates are normal, or they're a bit more detail oriented and they see that there's a pool of capital so that it will at least pay those interest rates for a while longer. And I think that pool of capital got reloaded as well. So it showed a commitment from people in the ecosystem or in the foundation to increase, to keep that discount going. And of course, it also acts as a draw to pull investors in. If you pay an unsustainable interest rate, it's kind of like, rate teasers. Banks will do that, and other interest providing institutions will provide teaser rates as to try and pull customers in, and then the rates will drop, and they'll offer a new product with teaser rates, and it's just a regular cycle. And so effectively we're doing that, and so that and presumably some of that money, it's ambiguous to me where that money came from. If that was some of the VC original money that was invested, or if it came from Luna price appreciation of the Luna Foundation itself, because presumably it owned a big chunk of Luna. And so in a way, that was a bit Ponzi-like, because you're sort of taking money from new investors and giving it to previous investors as an artificially high yield. And that is actually classic Ponzi. But I would say for balance that, teaser rates are an established thing that, new financial, new bank products use frequently, and a lot of startups will actually do, right, to offer a good deal, to get noticed, to get customers, or even mobile phone manufacturers. They'll
kind of like a lost leader, right?
Yeah, effectively to get. But the punchline is that ultimately there should be a sustainable product when you let it. If you amass enough users so that it bootstraps a market, and then you let the rates fall to market rates, that it should be sustainable. And the problem here is it's it's a bit like a housing bubble. There's a huge amount of leverage implied, and so as soon as the rates change, the whole thing collapses spectacularly.
Also, you've got a lot of competition in this kind of lending space within DeFi, and your clients are not sticky at all. So they need to compete on these rates as well. So I think it's hard for them to offer a very high rate and then go back to something that's less competitive, because there's no cost for your users to switch to like platform B that's doing the exact same thing.
Right.
So I think that's kind of a tricky thing to navigate for them as well, if they're trying to do this in good faith.
Yeah, I mean, I think you do that. That's true, and it's a kind of race to the bottom. So,
Yeah.
I saw that Tron has kind of made a clone of Justin Sun from Tron, another similar
Let me
thing.
correct you. His Excellency, Justin Sun. Sorry.
Yeah, wherever he got that from, I wasn't paying attention to that, but I did see his new Twitter handle. So, anyway, he's now offering, I don't know, like 40% APR with a clone of this whole Terra anchor protocol. So it's literally just a copy, but an even more unsustainable rate. And I mean, I suppose in the context of this recent collapse, he has to offer a lot to get anybody to risk anything, right? The other curious thing is that there was, an advertised attempt. So the Terra Foundation, Luna Foundation, spoke, during the start of the collapse about the concept that they were going to try and source additional institutional money to amass enough firepower to stop it collapsing. And of course, there were some billions. I'm not sure exactly how many because it was unclear how much was, actually raised as opposed to, their hope to raise. But there was at least $1 billion or $2 billion of institutional money. So, there might be a sunk cost element. If a particular fund was holding a lot of Luna still, they might have had an incentive to try and protect that investment, but evidently it collapsed too fast for anybody to, feel inclined to put good money after bad, effectively. So far, at least, they've failed to raise any more money. And of course, now it's collapsed to such an extent that, it's difficult to imagine making anybody whole or the brand being worth that much, right? Maybe it's almost a negative brand, and the management team is,
tainted.
Yeah, by the outcome.
Could that have ended differently? Like if they were able to have that redemption mechanism set? Because I didn't really understand how the Bitcoin was going to, it didn't seem like they had a plan for how the Bitcoin was going to back the stablecoin, right? It just seemed that part became completely discretionary, especially, I guess, as, the shit hit the fan and then they're just like winging it out to market makers. But do you think, is there a way where it could have ended differently if they had a transparent exchange mechanism? I guess that would depend on the details, but.
Yeah, so I think actually the fact that they had not implemented yet a way for the kind of automated arbitrage mechanism to sell Bitcoin or redeem Terra USD for Bitcoin actually maybe helped a bit, because I think, these transparent trading bots are pretty easy for people to game, because, as somebody who is trying to trade against it, what they've traded, how much they've got in reserve, and exactly what they're going to do in reaction to your market move. And so you can just take the optimal move to liquidate them, right? And that's effectively what happened. Whereas what happened with the Bitcoin part, the thing is, we don't know, even to this day, like a number of days after the precipitous drop, whether there are any Bitcoin left or whether even any Bitcoin was sold. All we know is that Bitcoin went to a centralized market maker with some discretion. And it may be that, depending on how much discretion they had, they might have had the wisdom to not, sell Bitcoin, like, lose further money selling Bitcoin. So it could be that they still have some left. We just don't know. But I think that makes life harder for the person who is trying to sort of trade on the, the negative sentiment that comes from the market, thinking that a lot of Bitcoin will be sold, right? Because now, some people may think, well, it's already sold it all, so like we don't care anymore, right? So then they probably have to close their short position because of that. Whereas if it had all been on market, all been transparent, they could have more effectively known exactly when to close their short position.
Yeah, it felt like there was a bit of a delayed reaction, because 24 hours later, I thought, at the time, I thought that they only had 40,000 Bitcoin to sell. So I thought, okay, if this is what a 40,000 Bitcoin sell looks like in 24 hours, then this market is super resilient. I can't believe we're still above 30,000. And then, 2 seconds later, it went it went down to like 24 or something. So there were, I think maybe they were diddling around with the market makers, and then they just finally let some go after that and whacked it again, or maybe something like. I think they seem to suffer from a case of oversharing in some cases. So I think also to flag the market that you're going to buy $10 billion Bitcoin, $10 billion worth of Bitcoin while you're actually buying is probably not a great idea either. Like,
right, exactly. Yeah, I think you'd have a disadvantage. I mean, as such, the bottom of the Bitcoin market is a little bit interesting in its own right, because I think the bottom on Bitfinex was higher, maybe 27-ish, 26 and a half. And yet on some other exchanges was lower. And I think that's because the the makeup of the investors on the platform.
Yeah.
So it makes it extra risky to use leverage trading, particularly, or limit like stop orders on exchanges that have a tendency to scam wick or flash crash below the fair market bottom, and so or exchanges that tend to crash under load. That's extremely dangerous as well. So people should be looking at that and taking notes and switching platforms or being more cautious about placing automated orders on exchanges with that tendency.
Yeah.
So I view the bottom as like more like 26, 27, 26 and a half. But others are saying 25, but that's just because they're looking at the price feed on exchange with too big of a mix of people prone to panic sell, basically, and they pushed, and it takes some time to arbitrage that.
Yeah, another thing that I noticed over the last couple of weeks was the velocity of stable coins too. I think is another way to look at them, because if you look back at Tether, if you look at Stablecoins War, they've got a velocity number, and its velocity for Tether is like 70 or 80%. And it's way higher than anything else. Like the other stable coins are half that, or maybe a fraction of that. And I think that's a really interesting metric, because I think it points to a key part of this trade was, I think, swapping some Bitcoin for UST and taking that liquidity out of the market and then selling and being able to dominate volume and really bully price around. And I think in something that has a higher velocity, I think that probably means that there's more use cases and there's more of that stable coin in different users' hands. And I think it's harder to dominate the volume. So I think that's an interesting thing, and maybe points to Tether being more resilient than its peers.
Yeah, well, I mean, there's certainly more liquidity in the on exchange markets, and I mean, of course, and in the redemption process, because it's actually dollar-based assets under it.
Yeah.
Whereas with Terra, you actually had the double problem, which is the market liquidity was a lot worse, much lower. I believe that the contagion, I mean, because one risk with stablecoins and DeFi, sorry, with DeFi particularly, is that there's a bit of recursion going on where people will, deposit assets into a yield platform like Anchor, and in some cases they get tokens reflecting their, the portion of the liquidity pool they own, and those tokens have their own value. So you'll say deposit $100 and get $80 worth of tokens out, assuming the token market keeps confidence, and then they'll take the tokens and they'll deposit them in another liquidity pool, and they'll get, and it'll just keep going. So there's a kind of murky, high leverage through sort of contagion risk and recursion in those platforms. Alan Farrington wrote an interesting article about that. It's called Only the Strong Will Survive, basically talking about the excessive and recursive leverage in DeFi platforms. So there is, to my mind, a risk of DeFi platform contagion if enough confidence is lost in one of the large ones that people pull a lot of capital out of it, and then the staking tokens lose value because it's a falling market in a because those don't have a fundamental value. It's just a kind of confidence value, and as there's a lot of leverage, it basically means things can get liquidated and force sold. Now it seems like the situation with Terra, because it was paying an unsustainable rate, is actually contained mostly because obviously lots of retail users lost money, some funds lost money, the original investors lost money if they hadn't already cashed out, the VC investors, but most of the Terra was not widely used for conventional stablecoin purposes. Actually, almost all staked into the Anchor protocol. because it was offering an unrealistic
Yeah, I
return, right?
think that its velocity when I looked at it a couple of weeks ago was like 5%, and Tether's was like 70 or 80. So I think that's what that points to is staking.
Right. So in a sense, the unsustainable rate meant that it was sticky. I mean, of course, it's not going to be highly liquid because it's new and people don't have confidence, and it doesn't have the the integrations and the traders' confidence, and they're not going to change pattern with something that works basically. And I think the kind of traders that use um, stablecoins a lot are going to be a bit more savvy about risks and stuff, right? So for trading anyway. So I think it didn't have liquidity for trading, but also it didn't have a lot of recursion and contagion risk, so that the teaser rate actually discouraged onwards lending, if you like. So that the Terra USD didn't infect that much, and
So kind of contained it.
yeah, it seems like coincidentally.
Yeah, Apollo had this point too in your Twitter Spaces chat with Arnab and Samson and Gabor. I guess two things. The first one was that it's kind of all fun and games until you get up to 10, 20, 30 billion, and you know, you really need to have access to something that's got deep liquidity. Otherwise, you're going to have problems. And I guess also you become a massive honeypot for these kinds of, people who are looking to take advantage of you. And then the other thing is that Paulo mentioned too was that, what's the point of a stablecoin being backed by another stablecoin? I mean, that just doesn't make any sense. If you're going to be 75% backed by USDC, like, let's just cut out the middleman. And yeah, what's the point? Yeah. Like, why are you here? Yeah.
A lot of people just want to buy Bitcoin and cold store it, and that's mostly what I do. I think that's a great idea. Don't leave your coins on exchange, etc. Right? But if you do some trading, which I also do with an allocation, and you run into problems with wire transfers. And so in 2013, for a number of years, this is a little before Blockstream and then continuing afterwards, I was doing arbitrage, where at that time there was no stable coins. This is before Tether, which was the first stablecoin. And the way you would do arbitrage is you would wire transfer to an exchange, buy that had a cheaper price, buy the Bitcoin, transfer them to another exchange, you sell them, you'd wire transfer the proceeds back to your bank, and then you complete the circle and send it back to the first exchange. And that whole loop, because there's 3 wire transfers involved, would take over a week.
Yeah.
And like, it's not just that it take a week. Like, if you don't do a wire transfer before the wire cut off, like maybe 2 p.m. or something, it's not going to happen the same day. Even if it's supposed to happen the same day, half the time it doesn't. And sometimes they just lose your funds, and you got to talk to them on the phone, if you can even reach them on the phone, and they have to trace it to see like where it got lost, and then that'll take more days. Apparently, according to one bank I use, it could take up to a month. Though I never had that unfortunate experience myself, but that could be pretty bad as well. And of course, they don't operate on weekends. And even if you're not doing arbitrage, this was quite bad for the Bitcoin market structure, because at the time, the price would fall just as a random news or, just volatility. And it would take, 2 or 3 days before people could get money on the exchange to buy the dip. And it's very predictable. You could see it kind of like, the price is down, yeah. 2 or 3 days. If you've got a liquidity, buy, because in 2 or 3 days it'll be back up, because the wires will hit the exchanges, people will buy. And so, stablecoins improved a lot of that, and Tether particularly pioneered the space. And so when people say, well, why do you care about stablecoins? Just buy Bitcoin, or that, this confused claim that Tether lost its peg. It's not that. It's the only reason people are using it. Well, the main reason people are using it is because bank transfers are just so bad as a user experience and speed of transfer and so on. So that's why people are using it, and that's why people will pay a premium to swap, wire transfer dollars for tethers faster, and then they can wait for the wires afterwards, because it's a sort of time is money market opportunity thing. So the whole space is started by that problem. So if governments and policymakers and regulators are concerned about this, they just need to make banks that have a transfer process that can transfer large amounts of money in seconds or minutes, and then it'll be fine. I mean, the UK particularly kind of quasi fixed this problem with so-called faster payments, and they are limited to, I think, 20, maybe £25,000, but they happen in like a minute or so. But apparently it's all fake. Like, really, it settles in 2 days as before.
Oh,
But they reached an agreement to show the balance and allow onwards resale and absorb the risk of it going wrong behind the scenes.
so can you double spend it? Can you?
I mean, probably at the edges that might happen, but generally, from the user's perspective, it appears to work. So, the banks just need to upgrade the technology so they can actually move final settled money in minutes instead of days.
Well, that's part of it, but I mean, I was surprised to hear that Bitcoin still has quite a bit. From the bank's perspective, some of these correspondent banks, I think there's still Bitcoin stigma, because I've heard of people who have their correspondent bank has denied the transaction, and this is from like regulated trading platforms. So I think there's still banks out there that don't want to interact with Bitcoin or the broader crypto industry at all. So I think that's another part of it too, is that not all banks will support this and will be problematic to different, levels. Whereas something like Tether is not only low volatility, it's low friction, which I think is part of the value proposition. If you get like a CBDC from, FedCoin, and it's low volatility, but it's high friction and they're all over what you can do with it, then I think that's not attractive.
Yeah, well, I mean, it adds to the unreliability, which
Yeah.
is, apart from being unreliable 1970s tech, it's also got human.
Yeah.
I mean, part of the reason it's unreliable is it's got human touch points where people are, dealing with these Swift messages and things, right? And they have to manually approve them or maybe retype them. And there's random policy stuff in there. Like, some, as you say, some banks don't like Bitcoin.
And they won't be public about it either. You can't find that out, and nobody will explain it to you.
Yeah, I mean, I think some of it may be a side effect of scammers. So there are people who, I mean, just financial fraudsters, basically, that will try to convince people to send them money or impersonate a financial institution or a financial offer, and they sometimes manage to fool retail investors without a lot of investment experience. And so the banks' kind of fraud departments and telephone support lines are clogged up with this stuff. And so, I guess, unfortunately, some of those scammers abuse crypto exchanges to to cash out, right? And so, but I mean, there is clearly still some overhang. The overhang is eroding too, though, because a lot of the big financial institutions on the investment side are starting to offer, Bitcoin denominated accounts
Yeah.
and Bitcoin related financial products and futures and derivatives and things. So it's got to meet in the middle at some point where you're just losing business by taking that approach in one part of the bank and not in others or something.
Yeah, no, I think so. So maybe we should try and wrap it up here, but I kind of wanted to finish on, what do you think are some of the key lessons that we should take away from what happened with Luna? I think for me, one of the big ones would be positioning. I'm kind of surprised by how many sophisticated investors, lost their shirt in this thing. I'm just surprised that people allocated so heavily to this to this ecosystem. So I think positioning is one of them. Know your limits and stay within it is a good motto to live by. What do you think are some of the lessons that people can take away from this fiasco?
Yeah, I mean, I think, unfortunately, there's a bit of perverse incentive, which it may not fully have reset or flushed out, which is that for the fund investors and insiders, if you like, they can potentially have already taken a profit out and actually contributed to the fall by withdrawing liquidity from it or market selling effectively. So while professional investors and large investors can make money doing this, they're going to be inclined to do it again. So that's to say that just because something is risky, may not work, or is predicted to not work, doesn't mean that people won't try to play the game. So, a lot of the altcoin trading sector is basically a game of knowing participants who know it's going to, collapse or be eclipsed, taken over by something else in a period of time, and they're just playing a timing game. I was like, well, I'll collect the yield until the yield pool is dry and the rates drop to market, and then I'll switch to the next one, and I'll keep an eye on, on the sort of precipitous fall and get out before the next guy. And some of them succeed in doing that, right? Or if they were early enough, they got out early and left some house money in there. So, probably some professionals even got burnt in this. So that will make them more cautious.
Yeah, no, I think that that makes sense, and that's something that I've noticed as well. Is that these things can still be very profitable for people if they can get their timing right. And I think I've in Taiwan, kind of China area, this Ponzi thing has been around for a long time. Like this is crypto is just the newest iteration of this thing, and people will have bought into these things for a long time, and they just think they can get the timing right, and they know it's a Ponzi, and they're just anticipating getting out before everybody else.
I mean, I think that actually accounts for like 90% of the altcoin market, if not more, actually. I think people know the score,
Yeah.
but they want to play with a casino, basically.
Yeah.
And it's risky.
But that comes back to positioning too. That can be, I can see that being fun. But you shouldn't have 100% of your allocation. I mean, how do you sleep at night doing that? I mean, maybe it's like 1% or something, but
yeah, I mean, myself, I just keep completely out of it because, I mean, apart from the risk profile of it, it seems to me as, unproductive to the extent of, misallocation of capital, creating larger and larger casino or Ponzi-like things. I mean, eventually that's going to cause regulators to step in. Maybe the pendulum will swing too far on the regulation side. And it's not allocating capital to, value. Ultimately, value for humanity comes from building products and services that improve the quality of life, improve economic well-being, and that's generally reflected in stock prices of public and private stocks, right? And this is none of that. I mean, it's actually sucking capital out of productive uses of capital, so probably slowing down, human progress, if you like, or development of new, technology.
yeah, no, I think that's a fair point, and probably a good place for us to wrap things up. So, Adam, I appreciate your time today. This is a really good conversation, and hopefully we have a better week of trading going forward.
Yeah.
All right. Thanks again.
Thank you.